You know, I talk to a lot of people, and the number one topic that I've heard a lot in most recent years is saying, I never want to go through another 2008 again. Why? People lost 35%, 40%, 50%. I've talked to some individuals, the numbers have been even higher than that, 60%. The length of time it took people to recover from that big downturn, 3 years, 4 years, 5 years. I talked to one individual, he said it took 7 years to fully recover the downturn of his portfolio. I mean, that's getting close to a full decade. So the emotion that is tied to this, people saying, I never want to go through that. I hear their pain. I feel what they've gone through. And many people have been affected across not just the United States, but the whole world. So in understanding that pain, that financial pain, we have to understand what caused that. So, and that is the topic, what we're going to talk about today. Corporate debt. It's rearing its head once again, and the numbers look way more severe than 2008. We're going to talk about that in a moment. So thanks for watching today. I'm David Fisher, CEO of Landmark Capital. I've been in the industry for 26 years, and we believe in education. So we're talking today about corporate debt. You know, there was recently at the World Economic Forum in Davos, Switzerland, they talked about three main topics, and one of the three topics, it was the 50-year annual convention, one of the three topics was debt. Ironically, you would think that for them to talk about that, it must be a problem. Obviously it is, because the year before this in Davos, Switzerland at the World Economic Forum, it was the number one topic back then. This forum is, who attends is financial news, hedge fund managers, billionaires, heads of state, anybody that has anything to do with economics and financial investments on a large scale globally are the ones that attend to this. So debt is a big problem. We're going to focus in not on the full picture of debt, because there's different types of debt. There's sovereign debt, there's personal debt, and then there's corporate debt. So today we're going to talk about corporate debt. So to understand, before we get into the numbers, which are devastating, we're going to talk about really what is corporate debt. Well, if you owned a company and it traded publicly and you wanted to issue a bond, a debt instrument, a corporate bond, that is just for the purpose of raising money. What might be that for? Well, let's say you want to expand and develop a research and development area. You need the money to build the brick and mortar. Maybe you're going to go on a hiring spree and you wanted to hire a whole new class of area division within your company, and you need the cash flow to do that, so you issue a bond. Maybe you're already in debt and these bond payments are coming due, and maybe you don't have the money to pay for that, and you have to issue another bond to raise capital to pay for the bond payments that are coming due. That's the shell game, and that unfortunately is what is happening also right now. So that's how bonds, and the purpose of it is created to raise capital to make payments or establish, in business. And maybe another reason is you might want to buy out your competition, but you got to raise the money to do that. That's another reason why they raise bond capital. So let's take a look at the different grading system of bonds so you can see how this is rated. So if we're talking about, your grade school card, A is the top, B, C, D, and you don't want to get an F, certainly not. The rating agencies, how corporate bonds are rated, are somewhat similar to that. Obviously, A is the best, and the lower letters are worse. So at the top you have your best, what you call your best rated bonds, which has the highest quality and the least amount of risk, and that's AAA and AA. Then we get into the next section down, which is A and triple B. That is what you call your medium grade or your investment grade. This is like the heartbeat of usually the biggest percentages of the whole bond, the total amount of bonds out there. This is what you call one step above junk class. Junk is not a bond you typically want to own because it's a high risk bond, and this is going to be a grade like double B, B, and triple C, etc. So those are really low quality credit graded bonds. These companies typically are having financial challenges. They can't make their payments. They have a high debt load. They don't look like they're going to produce revenue to pay for things. And so the investor's taking on a high risk. That's why they have a low rating in the grading scale. So let's take a look at the numbers. Let's go back before the crisis in 2007. In 2008. So in 2007, the total bond market capitalization was $4.9 trillion. A year later, when Bear Stearns could not make their bond payments, that affected the next entity the next day, Lehman Brothers, which was expecting payments, and because they were tied in together called systemic risk, they couldn't make their payments. There was a cash flow issue going on, and then this just caused the domino effect. Then it just totally affected the market. So it happened really quick in just a couple days, and it just went significantly worse from there. We all know the story. But in 2008, the total bond market capitalization was $6.6 trillion. So we went from 4.9 to 6.6 trillion. 6.6 trillion. Keep that number in mind. That's what triggered. That's what triggered. And also CLOs, collateral loan obligations. In other words, leverage money. And a bond is really a leverage money tool also, because you're taking risk and you're hoping that this company will pay back its debt. Those are the things that triggered 2008. So remember that number, 6.6 trillion. Let's fast forward. There's an article that came out in November of 2018. So we're talking about a couple years ago. The title of the article said, a $9 trillion corporate debt bomb is bubbling in the economy. So back then, it was a big problem. $9.1 trillion is actually what the market was. It swelled from 4.9 to 9 trillion in 2007 to 2018, according to the Securities Industry and Financial Markets Association. But we didn't stop there. Where are we today? $15.5 trillion. So think with me. Just in the last couple years, it's gone from 9.1 to 15.5 trillion. That's a hockey stick. That's 6.6 trillion. That's the same number. That's the increase in the last couple of years as the total number that caused the whole system to come down in 2008. So to say we're close to a bond bubble bursting is really an understatement. Let's take a look at now what I think about it, or what economists are thinking about it. Let's see what the Fed says about it, or the Institute of International Finance. They put a chart. Let's bring up the chart now and take a look at the very end of the chart. In 2019, we're currently at, look at the blue line there, I'm going to say about 33%. So we have a 33% probability of a recession happening in the next 12 months. So you can go, whew, we're okay. Only a third chance of it happening. Well, let's put it into perspective now. Go back a little bit in the chart in the timeline and look at the vertical gray line. That's the recession, 2008, where it started. And go back just a little bit further to the spike in 2007. The probability of having a recession back then was 42%, according to the Fed. So obviously it was less than 50, and the Fed was way off in their predictions. I think they're way off again. And the Fed back then said in January that they don't see a recession in the near term. Boy, were they significantly off on that. So let's take a look at what the loans are today. There's a thing called top leverage loans of concern. In other words, what are the loans out there that should concern us most, and what is the percentage of those that are coming due? So the number is that 20% of the top loans of concern are coming due by the end of this year in 2020. And another 46% are coming due of loans of concern by the end of 2021. So that says a big chunk of this $15.5 trillion loans are coming due in the next year or two. You know, what if we have one event, one topic, that unravels it, one major entity that can't make their payments, and we have another 2008 all over again. I've always said I'd rather be 2 years too early to the problem than 2 days too late, because when it changes and turns, it's going to turn and change rapidly. Because one thing that we need to look at is, we looked at the total market capitalization that has grown, but now let's look at and peel the layer of the onion back, and let's take a look at how much is in the triple B market, which is, again, one step right above junk. So the triple B market has grown substantially. Back in 2007, it represented only 35% of the total market capitalization of the bond market, being 4.9 trillion. Today, the total market capitalization, 15.5 trillion, it now represents 50% of the total market capitalization of bonds. So that means 50% of the bonds are just one step above a junk crisis. The disturbing fact, according to Morgan Stanley, that in the last year, the default rate for bonds in triple Bs has risen by 50%. So something is up. They need more money. They're defaulting. Is the economy really slowing down? Maybe so. And this is a factor that we cannot ignore. So this is why a lot of experts are saying this is going to turn into a mess. Let's take a look at what some of those people are saying. How about Scott Minyard? He said this. Scott Minyard is a hedge fund manager for Guggenheim, by the way. He said this recently, quote, "We will reach a tipping point when investors will awake to the rising tide of defaults and downgrades," end quote. So in other words, what Scott is saying, that we're gonna wake up and we're gonna see all this happening. The warning has already been out there, and we're going to see one or a couple entities cause this whole financial landscape to change. And then when it changes, massive downgrades are going to come. In other words, those triple B bonds that I was talking about will be downgraded to junk. In fact, many people that economists believe that Moody's and S&P, the rating agencies, should be re-looking at these triple B bonds out there and downgrading them to junk, a big portion of that. So what if they just did that? That could be the trigger. Let's look at what some more people are saying, experts. How about we get into the Morgan Stanley camp? They said that we're drifting from bad towards ugly right now when it comes to the bond market. And this is a guy, Chris Mettelli, who runs the derivative strategies for Morgan Stanley. He's the head. In other words, remember derivatives? The thing that brought down the derivatives, that thing that brought down the system? He's saying it's now getting ugly. And this is all around the corporate bond market. Keep that in mind. Mike Wilson from Morgan Stanley said this recently, quote, "This is unsustainable, but in the absence of a meaningful catalyst, it can also continue." That's why it continued back from 2018 until now, when CNBC issued a stark warning that there's a bubble forming. It hasn't burst yet. So, but all it takes, according to Mike Wilson and many others, it's just one catalyst. I've always said in this environment, we're 1 to 2 headlines away from this all changing. All we need is one catalyst, and unfortunately the numbers dictate what I'm describing as the reality of what we're facing. A few other people that are saying things. Bill Blaine. I could go on and on, quote some people. I'm just quote a couple more people. Bill Blaine, he works for Shard, strategist for Shard Capital, a leading investment firm. He's a conservative. He's been a columnist, a radio broadcaster. He's been around for 30 years. Really well-respected conservative man. He said this recently back in October, late October. Quote, if you wake up on a Casper mattress, work out on a Peloton before breakfast, Uber to your desk at WeWork, order DoorDash for lunch, take a Lyft home, and get dinner through Postmates, you've interacted with 7 companies that will collectively lose nearly $14 billion this year. So he said that back in October 19th. He's not the only ones that are saying, warning Will Rogers. UN Secretary Antonio Guterres recently said this publicly, quote, it is time to break the debt cycle or we will have a painful crisis. And Wall Street said this. The Wall Street Journal noted that in the past 12 months, 40% of the U.S. listed companies are losing money. So we have an underlying problem. This is why many people are suggesting get some gold in your portfolio, which is something that I'm an expert at. Now, let's take me out of it and let's go to the largest hedge fund in the world that is managed by one of the largest, wealthiest billionaires of the world, Ray Dalio. And he said this recently, just a couple weeks ago, about gold. Quote, if you don't own gold, you know neither history nor economics, end quote. He also said this recently, quote, I believe it would be both risk reducing and return enhancing to consider adding gold to one's portfolio, end quote. He said also that he predicts gold is going to move to $2,000 in the near future. Keep in mind, this is a hedge fund manager, people who like paper typically, historically, and now he's saying, make sure you have some gold in your portfolio. So, if you want to learn more about precious metals, gold, silver, and those other types of metals out there, I have a team here that I've built that can help you be properly educated. In fact, some of them have more experience than I. Call my company. You can see the number below, and you can learn about gold and silver and what it can do for your portfolio, how you can benefit. Because remember, gold went up 50% in 2008 and 250% in a 4-year period after that. You can learn about a thing called the 3 columns. What is that? Well, if you've never heard of that term before, then that should tell yourself that whoever you bought gold or silver from did not properly educate you before you bought. Or if you've never bought gold and silver, you should learn about what the 3 columns are, because this will make a huge difference in you helping making a decision first if you want to get some metals and what the different types of metals there is out there, the markets, what their benefits are, their drawbacks are, their upside potential, short-term downside risk, and also the fundamentals that have driven 3 major bull markets in the last few decades in gold. So, call my company and you can learn about that. Make sure, though, you hit the thumbs up button and give us the thumbs up on YouTube there. And if you like what you're seeing and you believe in education, make sure you hit the button subscribe to my channel there, because I got another video coming up real soon that I want you to learn about that is a bigger topic called sovereign debt. And we got a few more videos right behind this that we're going to talk about that will help you out and understand the economic environment in. And after you subscribe, hit the bell button so you get that notice that when the next video is coming due. So I have a question for you, and you can answer in the comments. Do you think that the corporate debt bubble is going to burst in 2020? Or do you think it's going to burst in 2021? Give me your thoughts on it. Maybe you think it's going to burst right around the corner, or maybe it's years away. I'd like to hear from you. I'd like to see what you think about this. But until then, remember, if you take care of your money now, It will be there to take care of you later. Thanks for tuning in today.